What's up everyone? I hope you all doing good. I'm your host, your dost, Keyur Lalani. Welcome to my YouTube channel. In today's video, we'll discuss about 7 things all beginners must know before they start investment, right? So before we start this video, I highly request, if you haven't subscribed my channel, please subscribe now and don't forget to press like button. So let's start this video. So most of people, they just follow other people. They say, okay, that guy buy this stock, I will buy and make some money. So that's a wrong mentality, you know. So first things, always do your homework, right? So let's say when you purchase new home, right? For example, let's say you purchase new home. Do you think, oh, my friend bought home in XYZ community, I will buy there? No. You first see what's the value, what's the price, right? What's the area? Is that area is good? Schools are good, right? Neighborhood, right? So there are so many other things you will check before you purchase any home, right? So same philosophy, same fundamental analysis we need to do when it comes to choose or pick stock. Another thing, when you buy any stock, you become a shareholder. What does this mean? You become a shareholder. You become owner. You become owner of that company. I know, let's say it depends on, it's not a big part but small, right? You have become very small owner, but you are the owner of the company when you purchase stock. So you need to make sure before you put any penny, any single penny, not I'm talking about hundreds or millions of dollars, even to invest 1 penny, you need to make sure that company is good, their fundamental is good. Then only after you find all these things, start put your money, right? So basically we need to do proper analysis. So now you might have questions. I don't know how to do analysis, right? I don't know how to do fundamental analysis. Fundamental analysis is very easy. You just need to follow step-by-step guide. Check my previous video. I particularly made that video to describe how I do fundamental analysis, okay? So very simple, it's very easy, it's not complicated. You know, people see it's too much complicated. No, there are so many resources available. We can utilize those resources and do the fundamental analysis. So let's start, this video. Let's say the first very important things we need to see is trends in earning growth. This is very important, right? Where you find this information? You will get this information from company's presentation. You will find this in company's presentation, particularly financial section, right? Or you can get from yearly presentation. So all this information, where do you find it? Investor relationship, right? Why trends in earning is very important? Let's say, for example, right? Let's clear these things first. All right. So let's say there is one company. His name is X, Y, and Z. I don't want to pick any company. What we need to do? Year 1, year 2, year 3, year 4, and year 5. Okay? So we need to compare how earning is growing, their growth, and this is number of years. So let's say this is 10, 15, 25, 35, 50. So now you can see the growth. The moment the company is growing, right, their earnings every year over year for last 5 years, right? So this is the very important factor. Any company you pick, make sure their earning growth, right, or gross, right, is there, it's upward movement, right? So anytime when you pick, make sure you check their earning growth, right, or earning growth, or I would say gross revenue, right? Another thing, so this is the first factor we need to consider, right? Trends in earning growth. Number 2, strength, company strength against what? Their peers. Peers means competitor, right? How the company we pick perform against their competition. That is very important. If we are not close to our competitors, something is wrong with the company, right? So we always need to check our company strength against its competition. Why we choose this company? Why we think this company is doing better than their competitor? What is the X factor, right? That is very important. I will give you the example. If you see last 15 years in car industry, automobile, right, industry, there is no invention, right? In the terms of car, if you see cars, there is no technology there. They just gave you small screen with a leather seat, alloyed wheel, just a cosmetic changes was there. Cosmetic changes. All companies, big companies like Ford, Toyota, Honda, if you see their cars, it's not improving like it must, like they are improving just the mileage per gas, those kind of area, but technology wise I don't see any big changes. Now think about this one company, right, named Tesla. Everybody knows Tesla. They come up with huge change in the industry. They start manufacturing EV, electric vehicle, right? And they implement very well. And now you see the difference. Tesla overnight, I would say overnight, within last 5 to 10 years, for any company, 5-10 years horizon, particularly for the brand new company, become the leader of the company. If you see in the world, I'm not just talking about the US, in entire world, Tesla is number 1 player or the company in car industry as a market cap. They beat even Ford, Toyota, Honda. Toyota is one of the biggest. They are the leaders in the a car industry. But now Tesla market cap is the number 1. So these kind of things we need to find about the company, right? Why our company doing good or will become the number 1 or top 10 players in the sector compared to its peers or competitors. So this is very important things, right? And it's easy to find, if you read all this presentation, investor relationship, you will get all this information, what company is doing, why they are doing, what's their future plan, everything, all this information you'll get there. Okay, so let's move to the next one. This is also very important thing, debt to equity ratio, right? So every company, for example, right, every company need or required money to grow. This is very basic, right? Every company required money to grow, to invent something, right? To expand. Without money, company is not succeed for future, right? Simple thing. In every big company, if you read their balance sheet, all company, even Amazon is one of the biggest company in entire world. Apple, same, one of the biggest company in entire world. They carry debt, which is normal, right? So what we need to look, any company we pick, we need to see debt to equity ratio. What is the ratio? Whether that ratio is normal, industry normal, we need to check against the industry, right? If it's normal, that's very, we don't need that ratio to become bigger, you know, the wider. So debt, how much debt they have versus their equity, right? Balance sheet or asset they have, we need to check the ratio. All right, number 4, this is everybody know, price to earning ratio, sometimes it's called PE ratio. This ratio will tell us the company's market value. In the simple terms, if PE ratio is higher, the company is more expensive. If the PE ratio is lower, meaning company is less expensive, right? So let's say, what is the ideal PE ratio? So first things to find out what is the ideal PE ratio, we need to check the market PE ratio, right? So based on market PE, we can find out our company is expensive or normal or less expensive, right? Let's say it does, this is just one terminology, right? So it doesn't mean if the PE ratio is higher, company is not good. That is completely wrong. Sometimes high growth PE, high growth company, their PE ratio is always high. I have seen people like 500 PE, even 1000 PE, right? Meaning what? If this number is high, meaning investor has big belief in this company's growth, right? Investor wants to pay more money and wants the stock of this company. That's why their PE is higher, right? Let's give an example. Easy way. Let's say some company's PE is 20, right? What does that mean? The company, every dollar company makes, we give them 20 times money when we purchase stock. So every dollar company will make, we give 20 times when we purchase stock share. So right, we give them $20. So this is the PE ratio. If the PE ratio is 20, meaning we give 20x money when we purchase the stock. So price to earning ratio is very important. Okay, so we need to consider price to earning when we purchase the stock. Fifth one, this is my favorite, dividend, right? Dividend create passive income, generate passive income, right? How company treating its dividend, what does that mean? Means we need to see the company dividend trend for 5 to 10 years, usually longer would be better, right? Does that company increase payment, dividend payment every year? So let's say if we see a chart like this, if company is increase the dividend for at least 5 years, I would consider that's a good company. Company only increase dividend when they are making enough money, right? Another thing to keep in mind, the dividend payout ratio must be less than 70%. We don't want our company paying all the money they got from profit and distribute to shareholder. Why? Because if company pays out everything in form of dividend, company doesn't have enough money to expand, to spend money in research, to come up with the new product. So we don't want any company that spending dividend more than 70%. We need to pick a company whose dividend payout ratio is less than 70%. So keep that thing in mind, okay? So next things, this is one of my main factor I would consider when I do fundamental analysis. The leadership is very important in any company to or do good in the upcoming years, right? So number one thing, we need to identify who is managing the company, who is their CEO, who is their entire management, right? So all these things are who how much do you trust the people at the top of the company who is managing this company, right? The trust factor is very important. For example, Reliance, right? Everybody know who is managing Reliance, right? And everybody know the Mukesh Ambani and their leadership, right? Always last 15-20 years, if you see Reliance, they have the consistent growth year over year, right? It's because of the people who is managing the company, right? That's very important. And I personally always prefer founder based company, right? What does that mean, founder based company? A company's founder is a CEO who runs the company. That's called the founder based company. So if I find any of that company, I feel comfortable, because I believe in their management. Alright, so this is very important. Effectiveness of leadership, effectiveness of the management, effectiveness of people who is running the company. We need to first identify those people, how they are doing, how many years of experience they have, So all this information again you can find in the company investor relationship, investor presentation. All right, so let's move to next, long-term strength and stability, right? Everybody knows stock market is volatile, right? Stock market, nature of the stock market is volatile, so we need to be considered, we don't need to pick any company that, let's say stock market down 5% and the company we pick goes down 25%, right? Most of time if you pick growth stock, these things will happen. In the other side, when the stock market is going up, the growth company give us a really good return too. So we need to see risk and reward point, right? So I say at some point a company is going to lose value in the market, but what really matters is long-term stability. We are a long-term investor, right? So it doesn't mean if the market is going down, obviously stock price will go down. It doesn't mean my company is not good, right? And we are not investing for 5, 6 or 7 months or year or two. We are here to invest for long term, to generate passive income, right? I always in this channel we always discuss about passive income. So I'm the big believer of long-term stability, long-term investment, and I always want to see the compounding effect for next 10 to 15 years when my portfolio is mature in the term of value, right? So I hope you like this 7 fundamental points, right? When you do stock pick, consider in the fundamental analysis. Number 1, PE growth, earning growth, competitor we need to see how our company is doing compared to the competitors, right? Debt to equity ratio, price to earning ratio called PE ratio, how the company treating its dividend, and leadership and long-term relationship. So these 7 points we must consider or spend our time doing research on these 7 points before we start purchase that stock. So I hope you will get some good information in this video. So if you like this video or if you have any questions, please write me down in the comment and I will make sure I will reply each and every of your comment. So I will see you in the next video.